Well, welcome everybody to the monthly Ellsworth Advisors monthly update. Today is February 10th, 2020, and as usual, we're going to start off with a little economic update from Cameron, and then I'll go into how the market's performed, how our portfolio has performed, and kind of what we see moving down the pipe here for the next several weeks. Cam, fire away.
Thank you, Kelly. Good morning, everybody. It's funny, the common themes that we keep talking about just keep showing up. So a lot of this information comes from the Bureau of Economic Analysis, but if you look at the U.S. again, over the last month, the U.S. consumer remains incredibly strong. Last week, I think we were all a little bit shocked that the U.S. created a robust 225,000 new jobs in January. That was easily besting the consensus estimate of 164,000 new jobs. The U.S. has now, over the past 3 months, added 211,000 new jobs, again, November, December, and January. That's easily besting the average that we saw over 2019. The unemployment rate in January did tick up slightly. It ticked up from 3.5%, which is a 50-year low, to 3.6%. But this ultra-tight labor market has really put a strain on wages, put a strain on the workforce. Wages over the past 12 months rose 3.1%. That's below the post-recession peak of 3.5%. But really, what it means is, if you look at a trillions of dollars service sector like we have today, wages even being up 3%, you're talking about a lot more disposable income in the system. That's driving the healthy consumer. That's driving consumer spending. That's really keeping this economy kind of humming. Interesting to note is that manufacturing has started to see some more strength. So after 6 straight months of contracting, the U.S. Manufacturing Index, the Purchasing Managers Index, which is the primary measure of manufacturing activity in the U.S., reached 50.9 in January of 2020. Any value over 50 indicates an expansion. This is up from 47.2 in December of 2019. So really a pretty strong increase in manufacturing, healthy consumer. Maybe manufacturing's coming back. Obviously, we've had some resolution on both the China issue, on the U.S. North America, and the U.S. Canada Mexico trade front. We've had a lot of good news since December of this year, and that seems to be playing out a little bit in manufacturing. Obviously, the biggest concern right now, and something that's causing a lot of volatility, is the coronavirus. Sorry, I almost just said coronavirus in China and spreading through Asia, and even we've seen reported cases throughout North America. And really the biggest issue here is we've had the Chinese New Year compounded with the coronavirus, and frankly, a lot of factories in China have been quarantined, have been forced into shutdowns. This really could take a pretty big toll on the world's manufacturing sector, China. And the more prolonged this issue becomes, the more quarantines, the more fatalities, the more news disruptions. This is really going to create a situation where we could see a slowing China that could drag the rest of the world economy down with it. There's also going to be, every time a new case pops up in a new country, that's going to cause a little bit of headline risk. So really, I expect a little bit of volatility as far as this issue. But, globally, you take away the coronavirus, and the developing world is really starting to accelerate again. The U.S. is on very stable footing. I think one of the things that you're really seeing that has kind of demonstrated this coronavirus impact is that U.S. government bond prices over the last couple of weeks, we've seen a fall in yield. Obviously, that means money coming into the U.S., into a safe haven, driving down our yields. That's something you usually see when there's global disruption. But, if we can get past this issue, I still don't see a lot of headwinds to growth in the U.S. and growth globally.
Now, the coronavirus, hotly debated. That's why we had the pullback. We had a strong month up until the last week or so of January. Then the news on the corona really came into fruition. The immediate knee-jerk reaction was, hey, this thing is going to be the next bubonic plague. It's going to crush the world economy. We've seen these things in the past.
Might be a little bit of hyperbole.
Yeah, we don't want to make light of it, but the reality is, and there's the debate is, okay, does this kind of postpone consumption? Life continues to go on economically, and for the most part, after a lot of the initial headline risk, the markets have kind of righted themselves. We were in a situation where we had a strong December, followed up by a pretty strong January until this news came out. So you could also argue maybe the market was looking for some kind of excuse to pull back, which we saw happen, but we also saw money kind of flow back in. Now money's kind of flowing a little bit more towards defensive type names, which is fine, but we're also seeing a big divergence when you look at growth-oriented names versus defensive-oriented names. The divergence in returns has gotten fairly large, and the valuations on the two groups has been large. I'd say we're probably more middle of the road towards maybe leaning more towards the defensive side. And when we talk about the returns, for the most part, our portfolios held up pretty well through the month and year to date compared to the markets, because that we're not just focused in on that growth side of the equation. Economically, Cam didn't give a GDP number, but the latest GDP number I heard for fourth quarter is 2.1%, which I think I was talking about 1.1 to 1.6. So fourth quarter is a lot stronger than I expected, and I think a lot of strategists expected, because of the, we had the trade tariffs with China was slowing manufacturing for the most part was down. It was below 50, as Cam talked about it. Things actually improved in December, in January. So now, things aren't as bad as everybody thought. Earnings-wise, 75% of companies have released fourth quarter results. 62% of those companies are ahead of expectations, and beating their expected, beating their estimated revenues and profits by about 5%. Earnings per share on pace to rise about 3% for the quarter. So earnings period of this earnings season has come in pretty well. We thought that might happen. We weren't 100% sure on it. That gives us base of, okay, yeah, we saw the market rise. Even going through the coronavirus, things are not bad at all.
In those earnings, the bar was set fairly low.
Yes.
But still, we're talking about even 3, 4, 5% growth is huge when you're talking about an economy of our size. Exactly. To see a company like Johnson & Johnson or Coca-Cola, consistently be able to return 3, 4, 5% growth, that's quite impressive when you think about the global brands that they are.
I agree. And if anything, a lot of the headwinds have diminished. Tariffs, that was a big headwind. The interest rate situation, inverted yield curve, that's kind of behind us. Now, it may have slightly inverted on the initial rush to treasuries, but the reality is rates across the, from short-term to long-term, they all came down.
It's a blip.
We're starting to see a little bit of gravitation back up. I think that'll continue. So in general, the landscape's set basically for more of a slow growth year, but a growth year, and earnings don't look too challenged. So we kind of like the short-term outlook. Obviously, Corona is going to continue to put some pressure, headline pressure on the markets, until we get out of flu season, which will be a month or so. That'll help. And there may be some resolution in the next couple of weeks, or actually once we get through that initial 2-week incubation period for the coronavirus, that may give us a little bit of idea, how much more is this going to spread, how much more impact is it going to have on the economy. So jumping into the markets, the markets themselves in January, the S&P fell 0.16%. Year to date through Friday, the S&P is up 0.69%. The Dow Jones in January fell 0.99%, so just less than 1%. Year to date, recovered almost all that. It's still down 0.38%. So January, both indices were negative. In the international world, year to date, international is still down 2.45%, which isn't surprising because a lot of
the impact is international.
Yeah, and it's helped, in China. The emerging market side of the equation, down 4.87%, which obviously China is influencing that, and China has definitely seen some constriction and growth and a slowdown there just because of all the quarantine that's going on there, and then the headline risk around the virus. From a portfolio standpoint, our largest portfolio, our balanced portfolio, the growth with income portfolio, for the month of January, down 0.81%. Year to date, we're up 0.87%. So kind of in line with the markets. And then, year to date, we're a little bit ahead of the markets. And really in the growth with income, Year to date, Apple's been a big gainer for us, up 9.25%. That continues to, give us good gains. Visa up 7.9, Nvidia up 6.92. So some nice gains there. We've held a position in gold. Even gold is still up 3.42% year to date. Biggest detractors in growth with income. ExxonMobil, we're down 11.91% year to date, so that's definitely held us back. And then,
And what are we seeing today? Falling oil prices.
right,
Not
falling-
surprised.
Yeah, there's talk of less demand, and that trend continues, especially with the ample supply in the U.S. So, we could have some pressure on our Exxon position. Our commodity basket, where we hold, a basket of commodities in our PIMCO Commodity Real Return Fund, down 7.73% year to date. Once again, it's really an energy story. So that's kind of where we're at with the growth of the income portfolio. Our price potential portfolio in January held up really well, down 0.6%, so down slightly. Year to date, we're up 1.63, so well ahead of the averages there in price potential. Price potential, some decent earners in there. Top three, Motorola, we're up 11.37%. We bought Motorola about 24 months ago. That's been a big gainer for us. I think we're up 60% in there. That's been awesome. Allstate, year to date up 10.65%. So for an insurance company, that's pretty solid. We've been waiting for some pop there. We finally got it. Aon, another insurance company, 10.71% for the month, year to date, which is basically the month. So not real big gainers in price potential, but a couple solid gainers. There are several other high single-digit gainers in there. On the loss side in price potential, UPS has been a little bit of a drag, down 11.91%. Target, we've given some back there, down 9.83% for the year. And then Becton Dickinson, which we actually sold this morning, down 9.21. So farewell to them. We'll go elsewhere with that position. So once again, happy with price potential, kind of ahead of the game. The more quality orientation obviously helped, pretty much didn't feel the same pain as the indexes did in January. Dividend yield in January up 1.06%, so we had positive return there. Definitely bucked the markets. Year to date 2.59%. So nice little run for dividend yield in a choppy market. Big gainers there. Two double-digit gainers. Blackstone, once again, continues to give for us. Last year up about 40%.
It's the gift that keeps on giving.
Picked up another 13.28%, and I think this makes the K1s we've faced in the past with them all worthwhile. This will be the last time we deal with K1s for them, which is a good thing. And then Intel, year-to-date up 10.85%, so a nice little run from Intel. Everything else was single digits. Our big losers, LyondellBasell, which is a chemical company, down 13%. And we also hold UPS in this portfolio. So UPS kind of gave us some pain in both portfolios, down 11.91%. So dividend yield solid. Small cap portfolio in January up 2.25%. So nice gain there, which, smaller companies really more U.S. centric, less exposed to international trade. So they held up really well in the pullback at the end of the month. Year to date, up 5.29%. So small cap portfolio did well this month. Kind of continue to hang in there. Not a huge year last year, but a solid year. But now we're getting some outperformance. There are a couple big gainers. Appian up 39% for the year to date, pretty solid there. CyberArk 19.15. Walker & Dunlop, an a real estate company, 18.44. So some nice big gainers there. On the downside, the Federal Agricultural Mortgage Corp, not in there long. We were down about 13% in there. We actually sold that this morning also. And Verisight down 6.91. So no huge losers yet year to date, which typically in this portfolio, because it's small caps, any given month, usually somebody's taking it on the chin. This month, they're year to date so far not too bad. So SMID's hung up there pretty well. So that's kind of where we're at year to date. Once again, I think we're set up for a halfway decent year in the equity markets. Have to expect volatility, especially as we get closer to the election. But in general, we're in probably a fairly should we call cooperative environment for equities to keep kind of doing their thing. And we're not making any major changes strategy-wise, stick with a quality bias. And it's always going to come down to everybody's individual portfolio, make sure we have plenty of liquidity for any kind of upcoming needs or income needs. As long as we have liquidity there, we can handle the volatility.
And we really shouldn't be seeing a lot of traditional market moving news until first quarter earnings come out.
Yeah, we're going
To the fourth quarter, and now we're waiting on first quarter. There's going to be headline noise, but
Exactly. Yeah, we're going to get into this 8-week period or so where it's going to be the headlines that push things around. Still have a couple more weeks of earnings. That should be generally positive. Then we get into that period where everything is going to be is headline news, which means coronavirus potentially. There could be squawking about the Fed, but I don't see the Fed raising rates. It's just the debate of the lower rates, which, in personal opinion, I don't think there's any reason they need to lower rates.
well, but you look at somebody like we talked about, like UPS. I mean, that's all coronavirus related.
I think so.
That's the global trade and global shipping and logistics and basically China being shut down to aircraft. I mean, that's headline risk right there. And that's when
agree.
you buy good quality companies, as soon as coronavirus blows over, UPS is still a great company.
Exactly. I agree.
That's why we do what we do.
So that's where we're at. If you have any questions, want to discuss your accounts, or have specific things we want to talk about, please reach out and give us a call. If not, we'll be back here in a couple weeks. Thank you.
Thank you for your business.